Well, there's investing and then there's speculation, and then there is speculating that an increase in private jet traffic to Omaha is in fact a series of regional bank CEOs looking for a bailout from Warren Buffett. For those unaware, there's currently a great degree of speculation about Warren Buffett potentially being in talks with a number of regional bank CEOs about capital injections into their bank. The speculation has ranged from literally people tracking private jet traffic into Omaha's local airport, to a source familiar with the matter reporting that Buffett has been in communications with the Biden administration about a potential banking crisis. Now, all of this, of course, is fueled by the recent failure of Silicon Valley Bank, which has raised real concerns about which bank's depositors would and wouldn't be bailed out in a potential future banking crisis. Because all that regulators have really said so far is that they would step in only when a failure to kind of bail out depositors would result in some form of contagion in the US bank system. Which, funnily enough, the movement of a great number of deposits out of regional banks into larger banks is actually one of the few things that will cause a small regional bank, even if it's well capitalized, to fail. So is there any truth to these rumors of Warren Buffett potentially bailing out a series of regional US banks? Well, to be quite frank, we really don't know. I have no idea. I don't think anybody else has any idea either. Maybe it will be confirmed by the time this video comes out. Maybe it will be denied, or maybe we'll hear Buffett talk about it in the Berkshire Hathaway annual meeting this May. Right now, it really is just speculation, but what we do know is that Warren Buffett has made very important bank bailout style deals with a couple of large banks in the past, most notably with Goldman Sachs and Bank of America back in 2008 and 2011 respectively. Those deals steadied both the balance sheet and the reputation for those large financial institutions, and it also allowed Buffett to deploy Berkshire Hathaway's capital in a way that was relatively low risk, but also had the potential to generate very strong returns for Berkshire shareholders. So in this video, let's look back at a couple of those deals that Buffett made with some large US banks in 2008 and try to figure out how a potential regional bank bailout could look if there's any truth to these rumors. So if you enjoy the video and haven't subscribed to the channel already, please be sure to do so. But without further ado, let's get straight into the video. Now, firstly, I think it's important to understand why a regional bank executive might go to someone like Warren Buffett in the first place, as opposed to some other type of lender for a capital injection. And I think this clip from a interview that Andrew Ross Sorkin did with Buffett talking about the 2008 financial crisis explains pretty well why a regional bank, for example, might go to someone like Warren Buffett.
What does a call to Warren Buffett mean, you think?
Well, it means that they know we'll act fast if we like something. So we are the best fast buyer for anything that involves in the billions of just about anybody. And they knew I'm interested in the property casualty business in this particular case. And you know that they are desperate for something that's going to close within a few days.
So Buffett has built quite the reputation for being able to act fast and decisively, and also in size, where his scale allows him to be able to inject serious amounts of capital into even some of the largest US financial institutions that exist. But in most cases, these institutions are quite desperate. They need a lot of money, and they need it in a pretty short space of time. And for that reason, Buffett has been able to negotiate pretty favorable terms for Berkshire shareholders, and he's been able to generate good returns on his capital. Now, I want to look at this deal first because it was the first one chronologically. It happened in 2008, whereas the Bank of America deal happened in 2011. And frankly, those two deals were structured extremely similarly, which I will also cover in this video. Now, in the case of the Goldman Sachs deal, the first part of the deal was that Warren Buffett purchased $5 billion in preferred stock. Now, preferred shares are a little different to common stock, which most people will be familiar with. Preferred shares have a higher claim to the assets of a particular business than common stock, but less of a claim to those assets than bondholders, and they are typically paid an annual dividend. In the case of the Goldman Sachs deal, the $5 billion of preferred stock that Buffett bought received a 10% annual dividend. Now, in the case of a dividend on common stock, for example, if a business is going through struggles, there's a risk that they might cut that dividend. That is not the case with a preferred stock. That 10% dividend is always going to be very highly prioritized. But at the same time, preferred stock typically has less upside than common stock in a company. Now, as well as the 10% interest that Buffett negotiated on this $5 billion of preferred stock, he also gave Goldman the option to purchase back the preferred stock if they wish to, if they had the capital at some point in the future to buy the $5 billion of preferreds back. But if they did want to do that, he wanted a one-time 10% dividend. So essentially they could repurchase that $5 billion in preferred stock to no longer have to pay this 10% annual interest, but it would cost them $5.5 billion to do so. And Goldman did actually do that about 2.5 years later in March 2011. Now, to me, the preferred share kind of component of this deal, which is only half of the deal, I'll get to the rest of it shortly, is really the Buffett wanting to get his money back kind of part of the equation. He's getting 10% interest, a relatively high kind of annual yield on his capital, and he's getting it in the form of just pure cash. It's not like Goldman putting that 10% into repurchasing shares and growing Buffett's kind of overall ownership in Goldman Sachs or anything. He's just getting straight 10% cash back every single year. And I think the reason Buffett structured it that way really is to get as much of his capital back as quickly as he possibly could. Now, the second part of the Goldman deal to me is sort of the kicker to get a little more upside for Buffett. And basically that was for Goldman to agree to issue $5 billion in warrants for Goldman common stock at $115 per share. If you're unfamiliar with warrants, they're quite similar in many ways to a call option. They allow the investor to buy shares in the company, this time we're talking about common stock, at a particular price and on a particular date. Now, the only difference with warrants is that warrants are typically issued by the underlying company, in this case Goldman Sachs, whereas something like a call option is issued from another investor. And the way this would work in terms of the returns for Buffett is that, he had these warrants which gave him the option to purchase stock at $115 per share. So if at some point in the future Goldman's stock price was, say, $200 or $300 per share, he still had the option to buy them at $115. And that would therefore become quite a valuable instrument and kind of contract to have. Whereas if Goldman's price was under that $115 per share, those warrants would essentially expire worthless. Now, interestingly, Goldman actually renegotiated the warrants part of this deal. In sort of article that Goldman has on their website about the deal, it says Goldman also renegotiated the warrants in 2013, effectively allowing Berkshire to exercise them for free in exchange for a much smaller stake in the bank. Buffett's company received 13.1 million shares, giving it a roughly 3% stake in the bank, worth about $2.1 billion at the time. Under the original terms, it would have become the bank's largest shareholder. Now, outside of the $5 billion in preferred stock and $5 billion in warrants, there was also sort of a qualitative element that Buffett negotiated into the deal, really to get management incentives aligned with his incentives and with Berkshire Hathaway investors' incentives. And that was that Buffett stipulated that Goldman Sachs top executives pledged not to sell their own shares before Buffett sold his. So how did the Goldman deal work out for Buffett in terms of his returns? Now, firstly, let's look at the preferred stock. That's a relatively straightforward piece of the equation. Buffett laid out initially $5 billion in 2008. He then received his $5.5 billion back in March 2011. So that's his initial capital plus the one-off 10% dividend when Goldman repurchased the preferred shares. And in the 2.5-year period that those preferred shares were outstanding, he received $1.24 billion in dividends. So in 2.5 years on that $5 billion portion of this deal, Buffett made about a $1.75 billion gain, which is about a 35% gain. And when the warrants were renegotiated in 2013, Buffett received shares at the time worth about $2.1 billion. Now, Buffett actually held some of those shares for a little while. He sold them over a period of time at different prices, so we don't know exactly how much Buffett would have received for selling those Goldman shares that were a result of the warrants in this deal, but we do know that by 2013 they were worth $2.1 billion. And rather than exercising the warrants as was initially negotiated, those shares were basically given to Buffett for free. So he's gained $1.75 billion on the preferred, he's gained another $2.1 billion from the warrants, so that is a total gain of about $3.8 billion on about $5 billion in capital deployed. So a good result for Buffett, as it often is, and I should say a good result for Goldman as well. Goldman Sachs themselves say the day after the announcement, Goldman Sachs completed a public offering of 46.7 million shares of common stock at US $123 per share for proceeds of $5.75 billion in an offering that was well received and oversubscribed. So like I say, the kind of injection of capital from Buffett didn't only stabilize the balance sheet for Goldman, it also really stabilized their reputation and allowed them to raise even more capital. So it was in the end really a win-win deal for both Goldman Sachs and for Buffett and Berkshire Hathaway. Now moving to the second deal with Bank of America in 2011, this deal was very, very similar to the Goldman deal I just talked through. Again, it was a split of preferred stock and also warrants, and it was again $5 billion in each case. So very, very similar deal to Goldman, but with some slightly different terms. So this time around, the preferred stock actually only had a 6% dividend yield as opposed to the 10% dividend yield in the case of Goldman. But in this case, the warrants turned out to be exceptionally profitable and weren't renegotiated this time around. And Buffett made a lot of money out of the kind of warrants portion of the deal. When the deal was consummated, he negotiated warrants to purchase up to $5 billion of stock at about $7.14 per share of Bank of America. Most of those warrants were exercised in 2017 when Bank of America traded at approximately $25 per share. So essentially, he exercised his right to buy shares that in the open market were worth $25 for a price of only $7 and change. So that was about a 3.5x return on that chunk of the $5 billion of Berkshire's capital. He also earned his 6% dividend yield on the preferred stock in Bank of America that he held, and by exercising those warrants, he actually, in the process, became Bank of America's largest shareholder. Now, I think it's also worth noting that back in 2008, there were a couple of pretty notable deals that Warren Buffett got a phone call about and ended up turning down. Now, the first one was Lehman Brothers, one of the most famous bankruptcies that came out of the 08-09 financial crisis. Dick Fuld, the CEO of Lehman Brothers at the time, basically called Buffett and said, we need a $3 to $5 billion investment, and a quote from that call was, we're getting killed by short sellers, which Buffett later recounted as pretty much an immediate red flag from that phone call. He explains that he went through their 10K, their annual report. He was writing down basically page numbers on the front page. He was writing down all the page numbers throughout the 10K where he was finding problems. He said he was just too worried about their financial condition, and he knew that it was not for us. Very similar situation with the insurance company AIG. He said when he first got the call that it was a request for $10 billion. He told AIG, don't count on us, and that he just couldn't figure it out. He said, we could have paid it if I'd known what we were getting, but my interpretation of that is that the assets were just too complicated for even Buffett to understand. So all of this really begs the question, is a bailout likely to happen again from Buffett with a number of regional banks here in 2023? Well, I think there's a few kind of important points around that to work through. Firstly, there's a lot of speculation at this point that deposits are moving from smaller regional banks to larger banks, where potentially, there's a precedent now that those larger banks, when they fail, depositors are more likely to get bailed out. We also know that if that is happening, many banks are likely to need to raise capital if they basically can't sell their assets as fast as their deposits are flowing out. And in a lot of cases, for many banks, that's going to be the case. A lot of bank assets are generally tied up in loans or longer term securities, which, as we saw with Silicon Valley Bank, if you need to sell those and not hold them to maturity, that can result in some pretty serious losses in equity. But again, those things really happening are still speculation to a large extent. We should find out the true extent of movements in deposits from smaller banks to larger banks, if any, over the next several months as bank earnings continue to come out. So in principle, yes, I think Buffett could step in and help regional banks if they did need capital injections, but I think there's a couple of key reasons why Buffett might not be as interested in making a deal with regional banks as he was in making a deal with the likes of Goldman and Bank of America in times gone by. The first reason really is just absolute size. Now, Buffett has always been one to try and concentrate his investments in a relatively small number of very large investments in his portfolio, and Berkshire's at such a size now where there's not a whole lot of banks that could actually take, say, $5 billion in investment from Berkshire Hathaway. Buffett has many times in the past mentioned that he doesn't want to exceed 10% ownership in any given bank, largely due to the Bank Holding Company Act and a number of extra kind of regulatory burdens that would be put on Berkshire if they did go past that 10% threshold. And there's actually a number of examples either currently in Berkshire's portfolio or that have previously been in Berkshire's portfolio where they've been hard up against that 10% limit in kind of financial institutions. A current one is Ally Financial at the latest 13F for Berkshire. They owned 9.97% of Ally Financial. Ally kind of keeps repurchasing shares and Berkshire's ownership keeps going up. So they kind of continue to trim small amounts of Ally to stay under that 10% threshold. From 2017 to 2019, basically the exact same thing happened with Wells Fargo. Berkshire were right up against the 10% ownership threshold. Wells Fargo were repurchasing stock and lifting Berkshire's ownership in Wells Fargo by doing those share buybacks. And again, Berkshire just trimmed small amounts each quarter to remain under that 10% threshold. The only notable one where Berkshire could get meaningfully above 10% is actually with Bank of America. In April 2020, they applied to the Federal Reserve Bank of Richmond, and they actually received permission to lift their stake in Bank of America to 24.9% without extra regulatory requirements and that type of thing. But there is clearly a process that Berkshire need to go through to be able to purchase more than 10% of a bank. So that leads us to some pretty basic calculations at this point. If Buffett wants to put $5 billion into a bank and own less than 10% of it, that means we have to have a bank which has a market cap of at least $50 billion. So how many US banks are there that have a market cap of $50 billion? Well, by doing some screens and things, I managed to find a grand total of 9 banks in the United States with a market cap of $50 billion or greater. It's a really modest number of institutions, to be honest, and it's actually less than I expected when I went through and ran that screen. Interestingly, that number does jump from 9 to 14 if you were to throw, say, insurance companies into that basket. Insurance companies are equally as likely as banks at this point, I think, to have issues with the value of long-term bond portfolios, but they also don't have the bank run issues that many regional banks may be experiencing. So could Buffett do something with a range of different regional banks? Yes, I think in principle he could. We've seen in the past that he's done these types of deals and he's clearly interested in them, but if he was to make a number of kind of capital injections and investments into some of these smaller regional banks, he would really have to make quite a series of much smaller investments than he's done historically. So whether that's something that Buffett would even entertain is really yet to be seen, and it's a topic that I'll follow with interest and keep an eye on the news here to see if anything does emerge. So that's really all I have for this video. I hope that gave you a good overview of some of the ways Buffett structured these deals in the past with the likes of Goldman and Bank of America, and the potential likelihood that Buffett may make a deal with some smaller regional bank players here in 2023. If you enjoyed the video and haven't subscribed to the channel already, please be sure to do so. But that's it from me for this one, and I'll see you in the next video.